Okay, got it. All right, YouTube was giving me a lot of trouble. It has been, but it looks like we're good now. Okay, so today I want to do kind of a Q&A, kind of just go over some random different things, and we'll just kind of dive into different topics. If anybody has any questions, you can post them in the chat on Zoom or YouTube, or jump in here and just ask the questions. So first, I wanted to kind of go over something. We haven't talked about this on the podcast yet, but there is a interesting new investing strategy, I guess I'd call it, that I recently learned about. Um, that I wanted to share. So one of the things that we're looking at doing, I know we've talked about bonus depreciation on these calls and in our podcast. We are selling a couple of our properties that have a lot of equity this year. And so we're looking for ways to offset those gains so we can roll that money over into other investments and just keep more of the cash overall, and not have it go towards taxes. So one of the things that we've been looking at is bonus depreciation. So in order to do bonus depreciation, we would need to buy enough properties, qualify as real estate professionals, which we do a lot in real estate, so we should be able to qualify for that. But we would need to get enough real estate in order to take bonus depreciation for this year to offset those gains. And it gets a little tricky with bonus depreciation because you've got the land value, you've got the improvement value, improvements being the buildings. And then out of the buildings, when you do a cost segregation study, you take a portion that they're able to say, like, the materials, the copper and the wires, the plumbing, the windows, the roof material, all these materials, they say these are, if we break these out and pull them out as a whole building, you can take depreciation over a 5-year or a 7-year or a 15-year term instead of running it out 27 and a half years, which is the standard for residential property depreciation. So to do bonus depreciation, you can take the portion, usually it ends up being like 25% to 30% of the value of the improvement. So you're not getting all of it as depreciation, but if you get enough of a property, a large enough property or multiple properties, you can offset gains that way. So that's what we're looking at doing. And one of the things that I didn't realize is I was speaking to my financial advisor. I have like a yearly call, and I don't do a lot of investing with them. We do have some with them, and there's some family money with them. But I told them what had going on, and just said, "Hey, do you have any ideas? Any recommendations? I want to have money that we get from the sale, and I want to have it readily accessible." So we can buy more properties by the end of the year and put them in service, but I don't want to have them I don't want to have the money just sitting there not doing anything at all. So trying to figure out a way, okay, how do we have this money available, but still make money on it while it's sitting there? So one of the ways that I didn't even know about was you can put in. So I've never done bonds, like bonds and treasuries investing. It's kind of a slower, boring, uh, not a great return type of investment. I mean, it can be, but you're not going to have to look great returns. So one of the things that my advisor walked me through was a strategy I'd never heard of. Um, Basically investing in bonds. So instead of putting it into, I was looking at, like, a high yield savings account, or possibly doing like a CD or a money market. I wasn't real hip on the CDs because a lot of times you gotta lock up your money for 3, 6, 9, 12 months. And I don't want to lock it up. I want to make it where it's more accessible. Like if we find a property, we go under contract, we need that money in 30 days. So I don't need it like liquid like tomorrow, but I need to be able to access it within 30 days. So one of the things that you can do is you can invest in the bond market through mutual funds. So with mutual funds, it's like a mutual fund in your 401k, just traditional mutual funds, where you can get in, and it's almost like buying a stock. You can get in, you can get out at any point. So what you do with these mutual funds is you can invest into the bond market with mutual funds and get exposure to the bond market. And the bond market is kind of interesting. It kind of works in an interesting manner. So basically, you don't want to be in bonds and when I say bonds, we're talking like government bonds, corporate bonds, and these are like A-rated bonds. So these aren't junk bonds or just random companies. These are like, Disney and Walmart and all these big companies. And also I think there's a mix of the treasury bills in there as well. So you don't want to be in the bond market during an inflation period because the way that bonds react is it's kind of dependent on where interest rates are trending. So if interest rates are going up while the Fed is trying to curb inflation, you don't want exposure to the bond market. Like during 2022, when we had that really high inflation in one year, we actually saw the bond market. Like if you were invested in bonds that time, you would have actually lost money. So it would have been a negative return. Now it might not have been as bad as sitting in cash because if you're sitting in cash and with inflation, I mean, for the last 5 years, it was 20% inflation. So you literally would have lost 20% of the value of your money if it's just sitting in the bank, but your bonds still would have a negative return. Now, if interest rates are staying flat, kind of like they are now, or they're coming back down, this is when bond markets do really well. And I say really well, but you're probably looking at like 6 to 8% after fees because you're gonna have fees from the being in the mutual funds, but net of fees, you're probably looking between 6 and 8%. So to be able to lock up and get 6 to 8% on money that's readily accessible. With a mutual fund, you can sell it and it settles in 3 days, so you get your money in 3 days. And there's no additional downside in terms of like having your money locked up. And if the inflation does start to go up and rates start to go up to combat that, it's not like an overnight thing where a stock could crash. We could have an earnings call and it could explode or could crash overnight. But with the bond market, you've got a little more time, a little more warning. Things kind of start to react based on where they think they're going. So you can pull out if it's starting to get a little rocky or getting too low of a return. So it really gives you flexibility to get in and out of the bond market. But right now, with rates kind of coming down and now they're kind of flatlining. We don't really know what they're going to do, which way they're going to go. But in a market like this where they're staying flat or decreasing, this is when the bonds are going to do really well and get you that 6 to 8%. So compared to like the high yield savings account or a money market account where you're going to be like 3 to 4%, maybe you can find something in the low fours. I know there's some online banking companies and some credit unions that might offer that. But you're going to be able to get double the return that you would get in a savings account like that and still have your money accessible. Now it's not accessible same day like it would with those other accounts, but 3 days is still pretty good. So now that's not part of the strategy. That's just a holding. So that's a better way to hold your money than just doing cash or in a regular savings or a high yield savings account and still have access to it. Now, here's the really interesting part where this really becomes a strategy. So we're looking at buying properties this year for their bonus depreciation, and we have to buy them. We have to close on them this year and put them into service, or at least have them marketed as for rent by the end of the year to be able to take bonus depreciation in this calendar year. Now, in order to do that, we're going to have some sort of down payments, most likely. Our goal is to buy as much real estate or buy enough real estate to offset the gains, but using as little of that money as possible on down payments. So if we were just to go in and do 20, 25% down, we would probably end up spending all the money that we had just to be able to get the bonus depreciation. So our goal is to actually use as little as possible and use leverage to our advantage in this scenario. So we want to do like if we buy more creative stuff. So if we're able to find like 10% down, 5% down, I mean, even if you get 0% down, if you put nothing down, you buy a house and then put it out for rent, even though you had no money that you rolled over, it's not a 1031 exchange. Even though you didn't use any of those gains to buy that property, you can still take bonus depreciation and get the same write-off that you would if you had put 20% down. So the down payment doesn't really matter. It doesn't matter in this strategy. It doesn't matter how much we're rolling over. That has absolutely nothing to do with it. It just has to do with acquiring a new property and putting that into service. So, I mean, if we could buy enough property zero down and put those properties in service and get enough bonus depreciation on those cost seg studies to offset it, we could potentially offset all of our gains without even having to use any of the money. And that'd be an ideal situation. Probably not going to happen, but that's the goal, is to get as close to that as possible, get that depreciation without using the cash. Now, the strategy with the mutual funds holding bonds, when you have money with a brokerage like this, especially if it's a larger amount, and I don't know if there's a minimum, but let's just say it's 500,000 as a minimum. You have a million, I think at $1 million in assets, and it doesn't have to be in the mutual funds, but you have to have that money held with them. But they will allow you to take out a loan against that money. So it's called a margin loan. And if you have, the rates are pretty reasonable. If you have $1 million in the bank with them, again, it doesn't have to be in those mutual funds, but just $1 million invested with them. I think it's like 6.25 or 6.5. I think it's 6.25 right now, 6.25% that the money is going to cost you. There are no payments, so you do not make payments. It still accrues either way, but there's no payments on this money, and they will actually loan up to 40% of the money that you have held with them. So let's just use $1 million. If you have $1 million with a brokerage, they will allow you to borrow $400,000 at 6.25%. So how does that help you? It's a loan. You're still paying interest on it. The way that this becomes really interesting is that we could potentially, let's say we have $1 million in the bank with this brokerage. We could pull out $400,000 as a loan against our own money and pay the 6.25 interest. Now, again, you're not making payments, it's just accruing. So it's still costing you money, but you're not actually making monthly payments. We could use that $400,000 to go buy a big property or go buy multiple properties and disperse that $400,000, leverage that $400,000 to go buy bigger properties. So if we're doing, 10%, or I mean, even at 20% down, you're still going to be able to buy a decent amount of property that you would have had to use your other money versus pulling it out and giving yourself this loan. So I'm able to take $400,000, put that towards down payments on more properties, and I still have $1 million in the bank. Yes, there is a $400,000 balance on that loan, but I am now getting $400,000 to play with on my down payments. And I have $1 million here that's earning me that 6 to 8%. So the money doesn't stop earning money. So that's the cool thing about this, is that your $1 million is still working for you, even though you are borrowing against it. But you still are going to be earning that. Now you're 6.25% on the 400,000. So let's just say 400,000, 6.25. What's going on, you?
Hey,
How's it going, man?
good. How's it going? Yes.
All right, so your payment's gonna be roughly $2,000. If you're, I shouldn't say payment because there's no payment due, but your interest is gonna be about $2,000 a month on that $400,000 at the 6.25. Now, on the $1 million that you have, your $1 million, let's just say it's only getting 6%, just to stay safe. Your $1 million is going to be earning $5,000 a month. So if you wanted to make a payment and be paying that loan, like paying the interest on it, you could be paying the interest on that loan that you have, and you would still have an additional $3,000 to work with. And that $3,000 could actually be going towards the principal on that loan and actually paying it down. So if you just took that $1 million and put all the money towards that loan, it's going to pay it down until it gets to zero without you having to make those payments ever. And then now you're getting the income on the rental properties without taking two loans out, because the first loan's paying the down payment portion, and then hopefully you're cash flowing on the actual property itself. But that's a very unique way to leverage your money and make it grow and create more money to work with without actually having it. So just wanted to share that. We're going to be talking about it on the podcast, but that was something I just learned this last week. So excited about that. You got any questions? Anything?
Sure. I'll probably watch the replay for the first portion of it where you talk about, but
Sure.
I know you kind of you like built an ADU in Costa Mesa for your houses. Do you I'm actually looking into that probably closer towards the end of this year.
Okay.
Do you have any recommendations for like what to look out for? What do you look for when you're looking for a property that you could build an ADU on? And then like which cities in Orange County right now do you think is a good opportunity?
Yeah, so one thing we have not built an ADU. We have a property we were working on. The plan was to do two ADUs. We had a single family home. It's 1,300 square feet. We were going to redevelop it with a main house, two ADUs. So it's going to have like a junior ADU and a large ADU in the back. And then we were going to do like a granny flat that like opened into the house, but you could also close it off with communicating doors. So you could actually make it its own separate unit with a separate entrance. So we're essentially going to get four units, but in our city, this may be a California thing, but a lot of cities adopt it. You can only put two ADUs on a property if it's zoned residential. Um, if you get it rezoned as multifamily, then it opens it up. And there's people that do crazy things. They'll put like 31 units on a single family lot, but they get it zoned as multifamily. And I don't know all the like requirements for that, but I've heard of people buying a single family home, getting it rezoned, and then putting 31 units on it. So there's some crazy loophole to be able to do. 31 is the magic number for whatever reason.
Oh,
Um,
interesting.
yeah, so and I've actually known some people that have done some stuff like that. There's a guy in San Diego that does that, gets
Yeah,
really
I was gonna
creative with
say.
that. Um, but we actually decided to sell that house because we have a ton of equity. That's one of the houses that we're selling. And
Oh,
so instead of going through, because it was going to be really expensive to do this whole project, and money wise, I'm really kind of bummed because I really was excited about this project, but we have a lot of equity in this house, so we're actually going to end up selling this, and then we may end up doing something similar on another property. But we've had this for like 15 years, and
oh wow.
we only have about 12. Well, I guess we're about halfway through our depreciation cycle on it, but the depreciation is so low because of when we bought it that it doesn't really offset the income anymore. So we're better off restarting with a higher dollar property so we can get higher depreciation value to offset the income. So that's another thing too. When you have a property that appreciates a lot, you start your depreciation doesn't keep up with inflation. It just stays the same for 27 and a half years. So you end up with a property that's worth, four times what you paid for it and renting for four times, and you can't offset that income anymore because your depreciation is so low. Now, if we would have gone through and done this project, we could probably depreciate the expenses there, but it just wasn't penciling out and didn't make sense. But if you're like, are you looking at buying a property with ADUs or are you looking at building from scratch?
I'm looking at building from scratch or something like I think recently I met up with a friend in Fountain Valley and then this lady I met in Tustin. So they were showing me their projects. And so I was thinking like, okay, like, but everything is so expensive here. So I was like, oh man, like it doesn't really make any sense to kind of do it unless you just have deep pockets to, put
It's
in the construction
so
and all that
so
stuff.
here's the thing. If you do you have property already that you're looking at doing, or are you going to be acquiring the property?
I'll be looking to acquire the property.
So if you already have property, an ADU makes more sense, in my opinion, because you don't have to buy the property. You're only paying for the building at that point. So if
Right.
you look at your return on your ADU, it can be really like it can pencil out really nicely because you don't have to buy the land, and the land's expensive in California.
Yeah.
So it really pencils out if you already have a property that works for it. You're not having to invest in more land. If you're just looking to buy and start from scratch, I don't know that it makes that much sense. I mean, you got to pencil it out and see. But I would also tell you that if you can find a property that has an existing ADU that is not permitted, but it was built prior to 2020 and it's a very viable ADU, like they did a good job and it's like actually like a legit ADU, not just uh you know a garage that somebody converted like half. Like you see like people try to convert garages and they're not really converted. They just close it off and
Yeah.
throw a bed out there and call it, and it's like not safe. And it's like, okay, that's not, I wouldn't do that. But if you can find something, and I will say there are a lot, especially like Orange County along the beach cities, there are a lot of ADUs that people build in their backyards. And prior to like 2020, the laws were really strict on ADUs. The setbacks were 10 feet. You had to be 10 feet from the back property line. They changed all this about 4 or 5 years ago. And now I think, at least in our city, and I think most of the county, or it might even be a whole, I think it's actually a California thing. And a lot of cities have started adopting because California is really pushing ADUs, really trying to, obviously, with the housing crisis. Um, but they changed that to 4 feet. So a lot of these ADUs that were built, prior to 2020, 10 feet is a lot of setback to not build on. So people would build these ADUs within that 10 foot and couldn't get it permitted because of that 10-foot setback. Now that 4 foot, now all of a sudden it's could have been legal if this was the law back then. But you got all these ADUs that were built way back when. People don't want to go to the city and try to get it permitted because they don't want to open up all the walls and basically tear it down and start over. It's kind of pointless. However, the state of California recognizes this. They know there's these ADUs and they know there's a housing issue. They want safe housing for people. So they don't want these ADUs torn down because it's creating housing. A lot of people are looking for ADUs to live in. I see it all the time. Like, hey, does anybody have an ADU, some sort of second unit or something on their property, because it's more desirable than apartment building. You're in a suburban family neighborhood. Parking is usually better. You got your own place. It's just a lot more desirable. They also get more rent than apartments. They tend to rent a little better. So it's kind of a win-win situation. But with what California has done to help promote this, or to help create safe housing and get permits, is that they passed AB 2533. This just passed, was signed into law last year. Any ADU that's non-conforming, meaning non-permitted, that was built prior to January of 2020 has the ability through this bill to get permitted, like legally permitted, and get your certificate of occupancy. And I shouldn't say all you have to do, but it has to pass health and safety. So you do have to go through all the health and safety standards. My understanding, we're actually doing this on a property that we own. So I don't have a whole lot of information until we go through it, but I've done some research, and with the consulting firm I'm working with, um, you still have to submit plans. So you still have to go through the planning process, submit to the city, and you still have to pass health and safety. So they still come out for some of the inspections, but they're basically just coming out to make sure, my understanding is they're basically just coming out to make sure it's a safe living and habitable. Make sure you got your smoke detectors, make sure it's got, fire escapes. So you got egress, proper egress. You want to make sure that if there's a fire, that firefighters can get in and around the unit and make sure there's no issues. So my understanding is that a lot of the code that you would normally do kind of gets thrown out the window because they're not going to make you open walls to go and get your rough inspection and do all this stuff because nobody's going to do that. So they're like, well, people are living it anyway. So if we can get people to at least get it inspected, saying that it's safe and healthy, at least we're providing better housing for people. And there is a provision that protects you if you go to the city and for whatever reason you're not able to get that ADU approved. I shouldn't call it an ADU because it's non-conforming structure. But if you're not able to get it approved for whatever reason, the city cannot tell you to tear it down. So you do have amnesty on that through this bill. Like, hey, if you bring this to the city, because a lot of people don't even want to tell the city about it because they're afraid that they're going to make them tear it down. But if you bring it under this bill, you have protection that they cannot go back and tell you to tear it down. You're not going to get your certificate of occupancy. People would probably just go back and start renting it out anyway. I don't really know if there's any, I mean, there's no repercussions there because they can't tell you to tear it down at that point because you have this bill protecting you. So that being said, you might want to look into that a little more. And if you can find a property that has an existing ADU that's a good, viable ADU on it, um, knowing, and a lot of people probably don't even know about this, but knowing that you could get that potentially permitted, that square footage when you buy is not going to be included in the sale. Now, people will still pay more for it because people will still use them, but it's not going to be included in the sale. So you're going to get a better deal if it's not permitted now. If you can get that permitted, it's going to cost you a little bit of money, but a lot less money than building from scratch. So
Yeah.
that's what I would say. That might be a really good option and way to kind of look at the strategy. I love the ADU play if it makes sense. I think the if we buy more properties here in Orange County, we will probably look for something that has an ADU like that, or a good value add down the road. But I think ADUs are huge because it just adds to your income that the property's returning without having to pay, you still have the building costs or the permitting costs, but you don't have the land. And in Orange County, land is like 90, like 85 or 90% of the assessed value.
Oh wow.
So it's kind of crazy. Like that's how, if you look at the taxes, if you go to Redfin and you look up any property, it will tell you, it pulls the county tax assessor's information and it'll tell you the ratio. So if it says a property is $1 million, it'll show you that, 850,000 is land and $150,000 is the improvements, which is kind of crazy because you can't build a house for $150,000 anymore, but that's how they have it, how they have their ratios.
That's crazy. Yeah.
But
Yeah,
yeah, man,
that's a good
I love
tip.
it. Yeah, I love the ADU play. But yeah, I would definitely look at it. So it's AB 2533. Actually, let me double check just to make sure I'm saying that right. AB 20. It's funny because I tell the inspectors I had this property we're doing a new roof on that has this ADU, and they were asking about it, and I told them we're doing the AB 2533, and they have no idea what this is. I even called the city to find out more information as soon as this was signed into law last year, and they had no idea what it was either. I was like, okay. And then I was like, well, your website, it's on your website. And the guy's all, really? He like looks up, he's like, yeah. He's like, I don't even know what this is. And like, you're okay. I'm like, now's the time to do it. If you guys don't know what this is, then before you create all your red tape over the next couple of years, we need to get this thing approved. But yeah,
Yeah.
so I just looked up. It's Assembly Bill 2533, effective January 1st. So it came into law last year. And then as long as the ADU or junior ADU, so it works for the smaller ones too, was built before January 1st, 2020. So you have to be able to prove that. Um, Ours, for example, the neighbors had complained about it. And so it's on record with the city that there's a formal complaint filed back in like 1992. So I got proof. And then like, if you look at Google Maps, you can go back to the history and look and
That's
see,
true.
so that it's pretty easy to prove, but I would look into that because I think that's a big play right now because there is so many unpermitted ADUs out there, and you can get a better deal on those properties not having them permitted.
Yeah. Yeah, no, that's a really good point. Yeah, and the laws are always changing, and or these things are always being created, so most people don't know about it until like
Yeah, I mean, like I
probably
said,
a while after. Like
the
yeah,
city,
like I had no idea about
yeah, the
that.
inspectors, the inspectors right now, this has been in law for over a year now, and the inspectors have never even heard of this. And the actual building, like the building department at the city didn't know anything. It was on their website, so somebody knew about it. Like I'm sure the state sends it out when they send it, like, and they require all the cities to put it on there. But so somebody like put it on, but the webmaster guy knew about it, but nobody else at the counter had any idea what this was. They're like, you can't do
That's
that. And I'm
so
like,
funny.
no, you can, and you can't tell me I can't, and you can't tell me I can tear it down because I got protection of the state now. So, um, here's another thing. Are you going to be living on the property, or is this be a full investment property?
I'll probably start off living for, at least
Okay.
for a year, and then redecide afterwards.
Yeah. Okay. So the reason I asked that is because I don't know if there's anything right now, because this money goes really fast. But California, because of the pushes they're making on this, there's a lot of money and a lot of grants that they'll approve for ADUs. And usually it has to be a primary residence. So you can't do it as a fully investment property. But if you live in the property, you can qualify for these grants. I've seen, and again, they come out like every couple of years, they'll come out and there'll be a certain amount of money that's allotted, but it usually goes really fast because everybody jumps
Yeah.
on it. But
Yep.
I've seen like actual grants. It was like, I think it was like $50,000 towards your planning, permitting, and your initial build costs. So 50 grand to get you started. It was literally just a grant. Like you didn't like you could just like apply for it and I have this property and I want to do an ADU, and it like, your most expensive part to start the project is your plans. Your plans usually cost, 10,000 plus just to do
Right.
the planning and stuff. And that's before you can even apply for the permit or get the permit issued. So I would definitely check whatever city. I would check both city and county and state because they're all different entities and they all have different programs. So checks and like I said, that usually goes really fast, but I've seen city, county, and state do this stuff. They also do loan programs where the state will actually issue a loan. I think, and I don't know, it might be a program where there's another lender that does the actual loan, but it's through the state. They did one again. This one I think is all used up as well, but it was last year or the year before. I can't remember what it was called, but it was basically uh, a loan, I think of up to $150,000 or something. I don't remember exactly, but it was a sizable loan at a very, very good interest rate. I want to say it was like 4% or something. And
Jeez.
if you rented, once it was completed, if you rented the ADU to a HUD housing or a HUD qualified tenant, meaning a low income tenant that qualifies for that city, if you had a HUD tenant, they would forgive your payment every single month as long as you had
Oh
a HUD tenant.
wow.
So, and it was only 10 years. It was a 10-year loan. If you rented it to a HUD approved tenant for 10 years, they basically you can get the entire loan forgiven, and then after 10 years you could jack the rent up and do whatever you want. So it was basically like, we're going to give you this money and we're basically going to give it to you for free if you have a low income tenant in there that's HUD qualified for that city for 10 years. So it was a way to create, because especially in like Orange County, these more affluent areas, you don't see a lot of HUD housing, and cities are required to have a certain amount of HUD housing available, like a certain percentage.
Right.
So that's why you'll see like some cities are just like an area of all like a bunch of like manufactured homes or something, and they have to keep those because it qualifies them to that under that HUD ratio that they have to meet.
Yeah.
Um,
And I think like some apartments they usually have like a certain percentage of them have to be like for uh that kind of housing as well.
yeah, and I don't know if it's a certain percentage in that complex or if it's a certain percentage of complexes, but yeah, it's just like a number of units that are available to rent. They have to meet that criteria. So that's kind of like, why they throw this money out there, because they need this housing. And most people, especially in California along the beach, aren't, they're not going to rent something out for, because there's limits on what you can charge on the HUD applicants.
Yeah.
So if it's, $1,200, but your unit's going to rent for 25, who's going to rent it for 1,200 where they can rent for 2,500? Nobody.
Right.
So there's an incentive there. You're going to make a lot less on the actual, unit yourself, but your loan is forgiven. So that's like one of the like ways of getting it paid for without actually having to pay for it yourself.
Right. Yeah, I've seen that. And then I think I saw another loan program, but I was like, oh, I'm not too interested in that one. I think it was like for primary home buyers, but you if you were to ever sell that house, you have to pay the loan back or something.
That's
So
actually a
I was like,
really good program. I'll tell you what that is.
oh
That that
really?
that went in one day. The funds were gone. I know what you're talking about. It was like
Jeez.
it was, I think it was 2023. It was called home is like a home for everyone or something
Yeah.
home for everybody. It was basically they were going to give you your down payment, and I think it was like 20. If you're buying $1 million home, they're going to give you $200,000. It was a grant, or it wasn't a grant. It was a investment from the state. So they would give you $200,000 for your down payment and closing costs, whatever. It was up to 20%. So you could potentially, maybe it wasn't, I don't know what it was, but it was basically your down payment. Like if you're doing like a first time buyer program or something with 5% down, you were able to get, I can't remember the exact, but you were able to get your entire down payment plus closing costs paid for by the state. And they would put a lien on your home and say, okay, we got a $200,000 lien on your $1 million home. If there's no payments, you don't owe us anything. You don't have to make payments on it. But they had a lien for $200,000, and it was an investment. So it wasn't $200,000 lien. It was a lien that owned 20% of the property. So it's kind of like a home equity agreement, if you've heard of those.
Yeah.
So basically, if you ever refinance that or sold the property, that lien would have to get paid off. And then the state would be making 20% of whatever the value is at that time. This was 2023, or it might have been 2022, but I mean, a lot of properties have gone up quite a bit since then too. So the state's actually going to be making money on those as people get out of those investments. But yeah, that was actually a really good. We actually looked into that too because we were looking at
Oh
buying that
really?
property. Yeah, but it was literally gone in like one day. The funds were completely gone.
Crazy.
But yeah, there's a lot of programs like that, and even the city, like our city has. There are there's a lot of some of these have a lot of stipulations, and in California, like in Orange County especially, it just doesn't work. But there are grants and special loans you can get from the city, so the city will actually have money set aside for, again, you got to be primary residence, but they'll have money set aside for doing repairs if it's like something needs to be brought up to code or if it creates a health and safety hazard, which with homes, almost anything can create a health and safety hazard, I feel like. So you have a leaky roof, you need a new roof. Boom, you can get covered there. There was a lot of stuff you could, but you can't do like, oh, I want a new kitchen and I'm gonna remodel my
Right.
kitchen. So unless there's an issue in the kitchen that has to be tore out, like you can't do that. But some of these expenses that people don't normally want to spend money on, but need to be done, like a new roof, something like that qualified. So we the stipulation was there are some income requirements, which we usually qualify for because of all of our depreciation and everything. They look at your net, um, your AGI, your adjusted gross income. So if you're really good at offsetting your income, and that's what they look at. So you could make $200,000 a year, but if you have a $140,000 or $150,000 in write-offs, to them, to the government, you only make $50,000 a year. So that's what they're going to use as your income. So there are some income qualifications for those loans, or there's loans and grants. They do both. The loans are like, it's like, I think one of them was even a 0% loan. I think it was similar to the state. It was no interest. This one, they didn't take a percentage. It was no interest, no payments. You just had to pay it back when you refinanced or sold the house.
Yeah.
That was like free money because they didn't take a percentage. It was literally like whatever they gave you. It was like, I think it was up to $50,000. So they had a
Okay.
$50,000 lien on the property, and this is still available today in Costa Mesa.
Oh
Um,
wow.
but the tricky part and why we couldn't get it to work is that the property couldn't be worth more than like 1.1 or something like that. So,
Oh, that's like
and I mean,
nothing goes to miss.
we bought a house that was half demoed. It was like literally studs in half the rooms because it was flooded, and we bought it that way as is, and we paid 1.2. So it was like
Oh my
really hard.
gosh.
So we were trying to get really creative with it. We demoed it and took it all the way down to the studs to start the project, and then tried to get it appraised when it was like fully demoed and to submit. 'Cause I was like, look, these. I'm like, these houses don't exist in Costa Mesa. Like, this is like, who's going to qualify? They're like, yeah, no one actually qualifies because the houses are too much. So we just have this money sitting here. So I was like, what if I like tear it apart and get an appraisal? They're like, if you can get us an appraisal that shows that, then we can accept it. So we tried, but we still like the appraiser said, well, I have to comp it because by the time we did this, property values had gone up already. This was in like
Oh,
2023. And so property values had already gone up. It was going into the summer. He's like, I got to go with the comps and then we can take out like the stuff that you've removed. But he's like, I'm not going to be able to get you to where you need to be. So it ended up not working out, but we gave it a shot.
yeah. That was a good effort. Dang, that's
But
crazy.
yeah, every so city, county, and state, you got to look at all of them because they all have different programs. Now, again, once the money's gone, it's gone. So
Right.
it's always like changing, and then every year when they redo their budget, they'll sometimes a lot more to it. But check out all three of those because they all do different programs.
Do you just Google like all the grants and loans that come up for each city, county, and
Yeah, you know
state?
what? I bet you with ChatGPT and AI, it's probably way
Oh,
easier to
that's
find
true.
this stuff. But what I used to do is like, if you go to the city websites, you can search their site and you just search like you start searching like grants and loan, like home loan grants, home loans, home grants, like things like that, and it'll usually like direct you, or you just call the city in the city you're buying in or already bought in. You just call the city, and usually they have like a specific department that kind of handles that stuff, and they can like direct you or get you the right person. But it's worth a call. It's worth it doesn't take much to
Right.
pick up a phone or just search it and see if there's something, because if you can qualify for it, why not?
Yeah. Do you know if they all come out around like the same time? Like, is the budget set like in January, or does it kind of come out every like couple
I,
months or randomly?
yeah, it's an annual thing usually. I think usually it's like they set their budget, at the end of the year, whatever rolls over and whatever they approve, but it's usually beginning of the year. And then sometimes these programs, even though they've been approved, they don't have the money for it yet, so it doesn't start. Like that one that California did where they were the home for everybody, where they were buying a percentage of your home. That got it approved like the year before, and then it didn't actually go into effect until like April or something like that of the following year. It was like
Oh,
almost like, so everybody,
what?
so in this whole time, everybody knew about it because it had been talked about and hyped up and all this stuff. So like as soon as the application opened, like the money was gone like first day because there was so many
Dang, that's
people that
crazy.
that knew about it by then. But like that was a state thing. So the state California likes to push free money. Like whenever they have this stuff, it's funny because they'll have like, all these programs. They actually advertise the programs and push people to do these government programs because there's a lot of money behind the scenes that's made on it, I would assume. I'm
Yeah.
just speculating, but I don't know why they're advertising for people to do this stuff. But on the like the county and then the city, there's not, those ones probably aren't getting advertised. Like I never would have known if I didn't call the city or start searching to see if that was even available because it's not something they advertise. So those ones are a little more readily available and don't get eaten up as fast. So those ones definitely look into whatever city you end up buying in.
Yeah. Do you actually have any recommendations for cities? Because I've been looking at Tustin, Orange, um,
What's your
obviously the
goal?
cheaper ones.
What's your
Huh?
goal? Like, what's your goal? Are you trying to do it? Are you trying to turn this into a rental property at some point? Or is this just for your personal use?
No, I think it's kind of like gonna be like more so rental property, like long term. So uh maybe like first 2 years, like a starter home, and then build some equity by either building the ADU or converting it now from a non-conforming ADU to an actual one, and then just recycle that maybe like once or twice, and then eventually actually buy like a primary residence kind of thing.
Yeah.
But the first like 2 or 3 is probably just gonna be like rental property.
Yeah, I mean that's exactly what we did. We had
Yeah.
three of those in all in Costa Mesa, and we bought it, move into it, fixed up while we were there,
Yep.
build up the equity, pull equity out, do the next one. We did three. I mean, we've got almost $3 million in equity now, and we're getting ready to
Nice.
cash out two of those and then kind of start the process
Yeah.
over. Um, and again, this was the last 5 years. We got a ton of equity, so because of the inflation, it
Right.
helped us quite a bit. But there's still market appreciation, and then we push appreciation on all these properties. So the majority of it's actually pushed appreciation. So even if we didn't have all that inflation, we still pushed appreciation really quickly on these. So we still would have gotten quite a bit just with what we did. But I would say look not necessarily what's cheaper, like I mean, obviously it's got to be in your budget and you got to be able to qualify for it, but I would look at the how strong the market is. Are you looking at doing long-term rents or midterm rents or
Probably
short-term?
midterm rents since I already have experience in that.
So I would say you already know that market in Orange County. You know where all the leads are because you kind of are in touch with that. So I would buy in a market that's got a lot of leads. So Irvine, I know has leads, but there's hardly any MTRs in Irvine.
Yeah.
We just placed somebody the other day, yesterday actually, in our Corona Del Mar property, and they are in Irvine but couldn't find anything. Like the housing company they were working with was ALE Solutions, and they couldn't find anything, and the the owner couldn't find anything, and so I mean, they're happy to go to CDM, but the insurance approved it because, yeah, they're like, yeah, we can't find anything either. So we'll go ahead and approve. Just find us some, send us whatever you can find and we'll approve it. So, um, I would say like Irvine could be good. I think Irvine's probably more difficult to build like the ADU play because there's
Yeah.
not really land there.
Yep.
That's a little tougher. But that's a good spot for midterm. Costa Mesa is really good. We've done really well here. You get high appreciation and no HOAs in most homes. And the rental market here is extremely strong, both long term and midterm. You can't do short term, just like Irvine, but the midterm. I mean, we still get like we still turn a lot of people away. I don't even have people to refer them to because I'm getting probably 4 to 5 requests for each property that we actually fill.
Oh
So
wow.
we have a huge surplus. So we're getting ready. Once we get these properties sold, I'm also selling my business. I got way too much on my plate right now, but
Yeah.
we're going to be making a very big push on building the co-hosting and building our portfolio in Costa Mesa. I don't know that it makes sense to like build our so for our bonus depreciation that we're going to be looking to do, it's not great. The beach cities aren't great for that because the land is so high. So we may end up investing out of state or more inland to get the bonus depreciation, but I think we'll still end up buying a Costa Mesa just because it's such a strong market. So it's a really strong market for the home values. Like this is where I see the most value. If you were to ask me like putting price aside, what's the best market to buy in, I would tell you Costa Mesa. Because Newport, you're going to pay 2 to 3 times home values in a lot of those neighborhoods, but they don't rent for 2 to 3 times as much. they rent for, 20, 30, 40% more, and the return is just not there. So it's a strictly equity play in Newport, but you're not going to cover your holding costs.
Right.
Um, so you got to be careful, like not going too cheap on the purchase price to where, it's not going to actually do much for appreciation or actually rent for and cover or make any money. Because if you're doing midterm, you're obviously trying to cash flow.
Yeah. I'd say anything around Irvine is probably like a good bet. So like Mission Viejo, I've seen a
Mission
lot.
Viejo. Yeah, I see a
Yeah.
lot of requests in Mission Viejo, and there's not a lot there.
Yep.
We've got one property we do part-time there, but I see a ton. So I don't know what the rates go for there. You need to look a little more into that, but I do see quite a bit of demand in that area. So that's another really good market that go. Orange, I don't know much about Orange because we don't really do anything in Orange. It's probably I think it's a pretty good rental market because you got the college there, so there's a lot of people coming in and out, and then you got, closer to the hills. There's quite a bit of rental demand. We actually have a property we might be bringing on in June in Orange, so it'd be interesting to see how that goes. But I actually do like Orange as a city. I think I like Orange a little better than Tustin because I think there's a little more demand for Orange.
Yeah. I think Tustin is a little more expensive, depending on what parts of Tustin, but
It
from what
depends.
I've seen,
Yeah.
it's
If you're like
yeah.
North Tustin, that's like those properties get
Yeah.
way expensive. But I think that there's more demand in Orange because there's more commerce. You got the Orange Circle, you got the university there. So I think there's a little more demand in Orange. But I could be I haven't looked at it that close compared to Tustin. So
Right. Yeah. That's kind of like what my headspace is at currently anyways.
I would
Yeah.
stay away from places like Fountain Valley, because prices are lower, so they look attractive, and you're close to Huntington. You're close, you're right off the 405. But there's a lot of vacancies, especially in
Really?
midterms. A lot of people have a hard time filling in Fountain Valley, from what I've seen. I've got like Fountain Valley and Garden Grove, like kind of that whole area between the two freeways. There's just not nearly as much demand. So I see, which is funny because we have a Santa Ana
Yeah.
property we were doing, and we would get people coming over from Fountain Valley, but then I see all these owners, operators that like are like, in the groups and stuff, like I can't fill my property. And so I don't know.
Interesting.
Maybe it's just the owners. I don't know, but I do seem to, it just appears to me like it's not as strong of a market, at least in the MTR space.
Yeah. That's really interesting because it's like right next to Costa Mesa. So you would think like some of it would pour over there.
Yeah, but it's on the other side of it's like the other
Yeah.
side of the tracks. You know what I mean? It's like the other side of the
Yeah.
405, which is it's kind of like funny to say. It's like not that far. It's literally a couple minutes
Yeah.
away, but that's like, it's a perception thing.
It's a perception thing.
We
Yeah.
have a property in Santa Ana that's been extremely difficult. It's a nice property, got a pool, hot tub, 5 bedrooms. It's in a good neighborhood, but it's a Santa Ana zip code. So we really
Ah,
struggle. We struggle with that one. The only time we rent it is to people that are in Santa Ana or they're traveling from out of state, and it doesn't have that
interesting.
stigma doesn't mean anything to them. But anybody that's
Yeah.
this, anybody that's
From California.
displaced, yeah,
Yeah.
well, anybody that's in Orange County, like if you're in Irvine, Costa Mesa, Huntington, or Newport, those people aren't going to go to Santa Ana. They just won't do it, no matter how nice it
Right.
is. So
Right.
you got to be careful with that kind of the stigma from some of those cities as well.
Yeah. That's a good point. Huh, okay. Yeah.
Yeah.
Yeah, I was kind of considering, I think Orange, Mission Viejo, Tustin, Lake Forest was an option too. I do see a lot of development there because people that are getting priced out in Irvine are going there, but I'm just not sure if there's
I
a
think you're
stigma
better off
there at
with
all.
Mission Viejo because I think Mission Viejo's probably price point is pretty close to the same.
Yeah.
Mission Viejo also allows short-term rentals. So
Oh, I do remember that.
that's one
Yeah.
of the few cities that still allows it, and you have to get like a permit
Yes.
to operate. But from what I've heard, it's fairly easy to get, and they're pretty like liberal with that and lenient. So it is one of the few cities that still allows it. So because of that, it may be a little more expensive there, but I think you have a little more opportunity, and I see so many more requests in Mission Viejo than anywhere else down in that area.
Yeah. That makes sense. Yeah. I've seen a lot in Mission Viejo, so.
Yeah, it's
Yeah.
that's another good one that I would definitely evaluate.
Nice. All right. That kind of helps narrow things a little bit.
Cool,
Appreciate
man.
it.
Well, I'm glad you jumped on today and were able to answer some questions. Um, got a couple more minutes if you have anything else that you want to.
Oh, I was just gonna, I mean, the other question I have is just gonna be like, how has your experience been with Dan and kind of like the whole like AI stuff because I've been looking into that recently, and it's pretty cool stuff. So
Looking into AI or looking
just
into Dan Martell?
uh AI mainly, and
Okay.
then just because Dan's like probably the biggest influencer that talks about it, it just naturally leads
Yeah.
to him.
Yeah. I've been his coaching for a little over 6 months now. Yeah, probably about 6 months. Every call, every coaching call is like AI, AI, AI. What it started out when so that's kind of more of a recent thing. He's
Yeah,
always been in technology, and that's kind of his thing. But I would say 6 months ago when I started out, it was ChatGPT, ChatGPT, ChatGPT. Now he like doesn't like ChatGPT, but it was
yeah,
like every time somebody would ask a question, he'd be like, "Let me show you. The first thing you should do, ask ChatGPT, ask ChatGPT." So he was like always pushing that, and that actually got me to start using it because I wasn't really. I mean, I had a ChatGPT, but I wasn't really using it. But he's like, "You should
yeah.
use it for everything," and so I started using it way, way more because of that influence. And then he was the one that also pushed Manus, like when
Yeah.
Facebook or Meta acquired Manus, he was the one that was pushing on. He's like, everyone needs to go, you got to try this. And so I started using that. So I do get quite a bit of influence and like exposure to new products when they first launch. And he probably owns a dozen AI platforms now that he's
Startups. Yeah.
launching. But yeah, he's very, very, very big into it. So I do follow what he's doing. And I mean, it's definitely like helping my business and how I'm structuring. I'm selling my business and shutting down my operations to focus on AI and build software for
Oh
the same
wow.
industry. But I started actually, somebody got connected with through Dan's group, someone else that's in his coaching. They're helping me to basically, so I'm a print distributor. I do like print and promotional products, and it's very time intensive, and I just don't have the time to do it anymore. I just can't keep up. But they're building out AI to scrape emails. So somebody sends me an email, it will pull up a previous order that they've done, and it'll figure everything out. It'll do the quote for them, send them the invoice, get payment, send it to the vendor, send proofs back and forth, and then send them the tracking number when it ships. So like it literally
Oh
removes
wow.
me from the entire process. So I'm selling off like 80 to 90% of my business, keeping a small portion of it as my test, like demo, like working demo on this software. And then once I get this all dialed in, I'm going to take this software and sell it to other companies like mine in the same industry. So I'm kind of staying in the same industry, but I'm going to pivot to a software provider versus a hard goods provider. Because there's a lot of people in this industry that are older, they're like retired or semi-retired, and they keep doing this because it's a good income source for them, but it takes up their time. So if they can spend a little money up front and just automate the whole process, or automate it, 80 to 90% of it, I think it's a huge value add for a lot of people.
Yeah. No, that makes sense. So is the person in the dance group they're more like advanced in AI, so they're gonna help you build that
Yeah,
system
so
out?
that's what they do.
Or
They
okay.
That's what they do. It's a company that builds it out. So they're using Make. Are you familiar with Make?
Yeah. It's like
Yeah. So
NAN or
it's like NA,
Zapier or
yeah,
something.
NA, but
Yeah.
it's a little more. Well, my understanding is it breaks less. It's not as like customizable as N8N, like is more customizable. But with Make, it's like not as customizable, but it connects to a lot of things, and it connects to all the apps that I needed it to connect to. So it's kind of, once you set it up, it's kind of like more on autopilot and a little more reliable. But basically, the AI is going to scrape the email, figure out what it needs to do, and then using Make, it'll go into our ERP on the back end, find the previous order, and then just kind of starts connecting all the different apps and doing everything. Which some of these orders, could take 2 hours of time over the course of 2 weeks, and then now it's going to be done in like a few minutes, and with without me or an employee. So I'm kind of excited to see. We're getting ready to roll it out in the next couple of weeks.
Wow. Yeah, that's exciting. And congrats on selling off your business.
Yeah,
That's a
thanks.
big
That's
one.
I'm not in negotiations right now, so we haven't finalized it. I got a couple potential acquisition partners, so hopefully we'll have something finalized next week. But I needed more time because I I just got to buy back my time because I just don't have time for anything these days. Got way
Yeah,
too
you're
much
doing a
time
lot,
and four
especially with like
kids.
what 4 kids. Yeah, yeah, yeah. No, that's crazy. I don't know how you're doing all of that. That's crazy.
Yeah, it's nuts, man. All right, man. Well, I appreciate you joining me today.
Yeah.
I'll post this too once it'll be live on YouTube. I got it to work today, so you can go watch the first part of it
Oh,
as soon
nice.
as this is over.
All right. Thanks, Josh. Appreciate
Cool,
it.
man. All right, have a good one.